In this exercise, we will determine the amount that should be recorded as the cost of the land. We record a long-term asset at its cost plus all expenditures necessary to get the asset ready for use. The company purchases a tract of land and an existing building for $800,000. The company plans to remove the old building and construct a new restaurant on the site. We start with the purchase price of the land and building. In addition to the purchase price, the company pays closing costs, including title insurance of $5,000. This is a cost necessary to acquire the land, so the company capitalizes this cost. The company pays property taxes, which includes $8,000 of back taxes and $4,000 due for the current fiscal year, totaling $12,000. The amount is paid by waive on behalf of the seller. The $8,000 of back taxes is required to get the asset ready for use. The company could not acquire the land until it paid the back taxes. So, this amount is capitalized. However, the additional $4,000 in property taxes relates only to the current period, so the company records the amount as an expense in the current period. This amount is not capitalized. After closing the purchase, the company pays a contractor $50,000 to tear down the old building and remove it from the site. This amount has been spent to enable the company to construct a new restaurant on the site. This is capitalized because this expenditure is necessary to get the asset ready for use. The company is able to sell salvaged materials from the old building for $5,000. Note that the salvaged materials that were sold for $5,000 reduce the overall cost of the land. The company pays an additional $10,000 to level the land. This amount has been spent by the company to bring the asset to a usable condition and is therefore capitalized. We add all the capitalized amounts and deduct the amount the company received by selling the salvaged materials from the old building to calculate the total capitalized cost of the land. The total capitalized cost of the land is $868,000. In this exercise, we will record the expenditures for the new machine. The table lists all of the expenditures incurred in connection with the purchase of the new machine. To record the equipment purchase, we will first calculate the cost of the new machine. Recall that we record a long-term asset at its cost plus all expenditures necessary to get the asset ready for use. The cost would include the $100,000 purchase price, $6,000 sales tax, $1,000 shipment cost, and the $3,000 cost of installation. All these expenditures are necessary to bring the equipment to its location and ready for use. However, the $2,000 payment for the equipment's insurance over the first year of its use will be reported as prepaid insurance initially and expensed as it is incurred over the first year of coverage. Therefore, payment for the insurance is not included in the capitalized cost of the equipment. We add all the capitalized amounts to arrive at the total cost of equipment of $110,000. Note that the machine, including sales tax, was purchased on account, with payment due in 30 days. The other expenditures listed above were paid in cash. We record the purchase of equipment with a debit of $110,000 to equipment and a debit of $2,000 to prepaid insurance for the first year of insurance coverage. Note that both these are asset accounts. We credit $6,000 to cash for the payment made towards shipment, insurance, and installation costs, and we credit $106,000 to accounts payable for the purchase price of the machine plus the sales tax amount. In this exercise, we will determine the amounts that should be recorded in the separate accounts for the land, building, and equipment acquired in a basket purchase. Sometimes companies purchase more than one asset at a time for one purchase price. This is known as a basket purchase. In this exercise, the company purchases land, building, and equipment for a single purchase price of $900,000. However, the estimated fair values are $300,000 for land, $600,000 for building, and $100,000 for equipment. The total estimated fair value of all the assets is $1 million. Note that the $1 million total estimated fair value of the individual assets exceeds the $900,000 total purchase price. So, the purchase price of $900,000 will be allocated to the separate accounts for land, building, and equipment based on their relative fair values. The allocation percentage for land is 30%, which is calculated as the estimated fair value of $300,000 for the land divided by the total estimated fair value of $1 million. The recorded amount for land is calculated by multiplying the 30% allocation percentage by the total purchase price of $900,000. This results in $270,000. Similarly, we calculate the allocated values for the building and equipment. The sum of the recorded amounts for all of the assets equals $900,000, which is the total purchase price. In this exercise, we will record the cash expenditures for Brick Corporation. The table lists costs incurred by Brick Corporation in the first few months of its operation. The company incurred costs relating to a purchase and transfer of a patent, attorney's fees for the company's organization, and pre-opening employee salaries. Patents, trademarks, copyrights, franchises, and goodwill are examples of intangible assets and are another major category of long-term assets. Intangible assets have no physical substance, and purchased intangible assets are recorded in a manner similar to purchased property, plant, and equipment. They are recorded at their original costs, plus all other costs, such as legal and filing fees, necessary to get the assets ready for use. The entry to record the cash expenditures includes a $10,000 debit to legal fees expense paid to the attorneys, a $55,000 debit to patents, which includes the $50,000 purchase price and the $5,000 of legal and other fees, and a $75,000 debit to salaries expense for pre-opening employee salaries. We then credit cash for the total amount of $140,000. In this exercise, we will calculate the amount paid for goodwill. Goodwill is recorded by the acquiring company for the amount that the purchase price exceeds the fair value of the acquired company's identifiable net assets. The fair value of identifiable net assets is equal to the fair value of all assets acquired minus the fair value of all liabilities assumed. Mars Corporation acquired all the outstanding common stock of Brad Corporation for $30 million. The book values and fair values of Brad's assets and liabilities are listed in the table. The fair values of all identifiable assets acquired total $41 million, and the fair value of all liabilities assumed total $20 million. The fair value of identifiable net assets is equal to $21 million, which is $41 million minus $20 million. Goodwill is equal to $9 million. calculated as the difference of the $30 million purchase price and the $21 million fair value of net assets. In this exercise, we will identify patent costs, research and development expenses, and the basic criteria to help determine whether to capitalize or expense intangible related costs. The table lists the expenditures incurred by the company to modify one of its satellite models. The company has incurred expenses in the modification and management of its model and has capitalized all the costs listed to their patent account. During the year-end review, we need to determine which of these costs need to be capitalized to the patent account and which need to be expensed to the research and development expense account. Let's address the basic criteria for determining whether to capitalize or expense intangible related costs. When a firm purchases a patent, it records the patent as an intangible asset at its purchase price plus other costs, such as legal and filing fees, to secure the patent. When a firm develops a patent internally, it is required to expense the research and development costs as it incurs them. An exception to this rule is legal fees. Companies can record in their patent account the legal and filing fees to secure or defend the patent, even if it developed the patented item or process internally. If companies follow these basic criteria, it will help them determine whether to capitalize or expense intangible related costs. Because the technology was developed internally, the company can record only 2 of the listed expenditures in the patent account. These include the $70,000 legal fees for patent application and the $30,000 legal fees for successfully defending the new patent. These 2 expenses add up to a total of $100,000, which is the total amount the company can record in the patent account. The other expenditures listed need to be recorded as research and development expenses. The company expenses research and development costs as it incurs them. The expenses to be reported in the company's income statement will include $2 million for basic research, $1.3 million for engineering design work, $500,000 for development of the prototype device, and $300,000 for testing and modification. The company expenses a total of $4.1 million in research and development expenses to the income statement. In this exercise, we will identify the accounts relevant to different expenditures. An expenditure involves a debit to either an asset or an expense. An asset is a resource of the company. It has probable future benefit. We capitalize an expenditure after the acquisition of an asset if it increases the future benefits of the asset. We expense an expenditure if it benefits only the current period. The first transaction involves replacement of heating equipment. This is an improvement since it involves replacing a major component of an asset. Improvements usually increase future benefits. We capitalize it with a debit to the equipment account. In the second transaction, the company pays $700,000 for covering the patio area with glass. This is an addition, since it involves adding a new major component to an existing asset. This expense increases the future benefits for the company. We capitalize the cost of additions with a debit to the building account. The third expenditure involves annual building maintenance. This is a repairs and maintenance cost. We expense repairs and maintenance expenditures because they maintain a given level of benefits in the current period. We expense this in the current period with a debit to the repairs and maintenance expense account. In the fourth transaction, the company pays annual insurance for the facility. This is a prepayment where the cash outflow precedes the expense. These payments create future benefits, so we record them as assets at the time of purchase. The benefits provided by these assets expire in future periods, so we expense their cost over those future periods. We capitalize this prepayment by debiting it to the prepaid insurance account. Note that this asset will be expensed as the insurance coverage expires during the year. The next transaction involves placing a new sign above the restaurant. This is an addition, since it involves adding a new major component to an existing asset. Additions increase future benefits. We capitalize the cost of this addition with a debit to the equipment account. Note that the equipment account includes office equipment, furniture, and fixtures. In the final transaction, the company paves a gravel parking lot at a cost of $50,000. This is an improvement since it involves the cost of improving an asset. Improvements increase future benefits. We capitalize it with a debit to the land improvements account. Note that the land improvements account includes enhancements to property, such as parking lots, driveways, and private roads. In this exercise, we will calculate the depreciation expense using the straight line, double declining balance, and activity-based methods. Depreciation is the process of allocating the cost of an asset to an expense over its service life. The cost of the equipment is $42,000. The residual value is $2,000, and it has an estimated service life of 10 years. Using the straight line method to depreciate the asset, we allocate an equal amount of the depreciable cost to each year of the asset's service life. We divide the depreciable cost by the number of years in the asset's life to obtain the depreciation expense. The depreciable cost is the cost of the asset minus its estimated residual value. In this case, the depreciable cost is the difference between the $42,000 cost of the asset and the $2,000 residual value. We divide the $40,000 depreciable cost by the 10-year service life to obtain $4,000 as the depreciation expense per year. The declining balance method is an accelerated depreciation method. For the double declining balance method, the depreciation rate is double the straight line rate. First, we get the depreciation rate by dividing the number 2 by the estimated service life. In this example, the depreciation rate is 0.2, which is calculated as 2 divided by 10 years. Next, we calculate the depreciation expense by multiplying the beginning book value of the asset by the depreciation rate. In the first year, the beginning book value equals the asset's cost. So we multiply $42,000 by the depreciation rate of 0.2 to obtain $8,400 as the depreciation expense for the first year. In all subsequent years, the beginning book value of the asset will be calculated as the cost of the asset less any accumulated depreciation previously taken. In activity-based depreciation, we allocate an asset's cost based on its use. This company allocates the equipment cost based on the expected hours of use. The total expected hours of use is 10,000 hours. The company used the equipment for 1,500 hours in the first year. We first compute the depreciation rate per hour by dividing the depreciable cost by the number of expected hours of use. Depreciable cost is the difference between the $42,000 cost of the asset and the $2,000 residual value. Thus, the depreciation rate is $4 per hour. To calculate the depreciation expense for the first year, we multiply the depreciation rate by the actual hours used during the year. We multiply the depreciation rate of $4 per hour by the 1,500 actual hours of use to arrive at $6,000 as the depreciation expense. In this exercise, we will calculate the depreciation expense using the straight line, double declining balance, and activity-based methods. Depreciation is the process of allocating the cost of an asset to an expense over its service life. We are not allowed to depreciate any asset below its estimated residual value. The cost of the delivery van is $56,000. It has a residual value of $8,000 and an estimated service life of 4 years. Under the straight line method, we allocate an equal amount of the depreciable cost to each year of the asset's service life. We divide the depreciable cost by the estimated service life in years to obtain the depreciation expense. The depreciable cost is the cost of the asset minus its estimated residual value. In this case, the depreciable cost is the difference between the $56,000 cost of the asset and the $8,000 residual value. By dividing the $48,000 depreciable cost by the 4-year service life, we determine $12,000 as the annual depreciation expense. The declining balance method is an accelerated depreciation method. For the double declining balance method, the depreciation rate is double the straight line rate. First, we get the depreciation rate by dividing the number 2 by the estimated service life. In this example, the depreciation rate is 0.5, which is calculated as 2 divided by 4 years. Next, we calculate the depreciation expense as the beginning book value multiplied by the depreciation rate. Now we prepare the depreciation schedule to calculate the depreciation expense for the first 2 years. The depreciation expense for the first year is the beginning book value of $56,000 multiplied by the depreciation rate of 0.5. This is equal to $28,000. Since it is the first year, the accumulated depreciation is equal to the first year's depreciation expense of $28,000. The year-end book value of the asset is equal to $28,000, which is the beginning book value of $56,000 minus the accumulated depreciation of $28,000. This book value becomes the beginning book value for the following year. Similar calculations are made for year 2. The depreciation expense is $14,000. The sum of $14,000 depreciation expense and the $28,000 beginning balance of accumulated depreciation gives us the $42,000 balance in the accumulated depreciation account. The book value is further reduced by the amount of depreciation of $14,000. The total depreciation for the delivery van at the end of the second year is $42,000. In the activity-based method, we allocate an asset's cost based on its use. In this example, the company allocates the cost of the van based on the miles expected to be driven. We are not allowed to depreciate any asset below its estimated residual value. We first compute the depreciation rate per mile by dividing the depreciable cost by the number of miles expected to be driven. During the 4-year period, the company expects to drive the van for 120,000 miles. Depreciable cost is the difference between the $56,000 cost of the asset and the $8,000 residual value. Thus, we calculate the depreciation rate as 40 cents per mile. Depreciation expense per year is calculated by multiplying the depreciation rate by the actual miles driven for each year. Let us list the actual miles driven for each of these years. For the first year, we multiplied the depreciation rate of 40 cents per mile by the 33,000 actual miles to obtain the depreciation expense of $13,200. Since it is the first year, accumulated depreciation is equal to the first year depreciation expense of $13,200. The year-end book value of the asset is equal to $42,800, which is the beginning book value of $56,000 minus the $13,200 accumulated depreciation. For year 2, the depreciation expense is $14,400. The sum of $14,400 depreciation expense and the $13,200 beginning balance gives us the $27,600 balance in the accumulated depreciation account. The book value is reduced to $28,400. The total depreciation for the delivery van at the end of the second year is $27,600. In this exercise, we will calculate depreciation expense for a change in depreciation estimate. The cost of the equipment is $50,000, the residual value is $10,000, and it has an estimated service life of 4 years. Under the straight line method, we divide the depreciable cost by the service life of the asset to obtain the depreciation expense. The depreciable cost is the cost of the asset minus the estimated residual value. In this case, it is the difference between the $50,000 cost of the asset and the $10,000 residual value. We divide the $40,000 depreciable cost by the 4-year service life of the equipment to obtain $10,000 as depreciation expense per year. At the end of year 2, the company estimates the remaining service life of the equipment to be 4 more years, for a total service life of 6 years. The company also changes the estimated residual value to $6,000 from the original estimate of $10,000. To calculate the revised depreciation expense per year, we have to find the book value at the end of year 2. This can be done by subtracting the accumulated depreciation at the end of the second year from the $50,000 cost of the equipment. During the first 2 years, the total depreciation expense was $20,000, which equals the $10,000 annual depreciation expense per year multiplied by 2 years. The book value at the end of year 2 is $30,000. Subtracting the revised residual value of $6,000 from the end of the second year $30,000 book value gives the new depreciable cost of $24,000. Dividing this by the remaining service life of 4 years, the revised annual depreciation expense for years 3 to 6 is $6,000. In this exercise, we will calculate depreciation expense for the partial period using the straight line method. Safety Elevators acquired equipment on April 1, year 1, for $26,000. The company estimates a residual value of $2,000 and a 5-year service life. Using the straight line method, we divide the depreciable cost by the service life of the asset to obtain the depreciation expense. The depreciable cost is the purchase cost of the asset minus its estimated residual value. In this case, the depreciable cost is the difference between the $26,000 cost of the asset and the $2,000 residual value. We divide the $24,000 depreciable cost by the 5-year service life to obtain $4,800 as depreciation expense per year. Note that this is the depreciation expense for the full year. However, the company acquired the equipment on April 1, year 1. So, we record depreciation for only the portion of the first year that it owned the equipment. The purchase was made on April 1, and the company's year end is December 31. The company will record depreciation only for 9 months, that is, April to December. The depreciation expense for year 1 is calculated by multiplying the $4,800 full year depreciation by the 9 by 12 fraction of the year. This equals $3,600, and this amount is recorded as depreciation expense for the first year. For year 2, we record the full year depreciation expense of $4,800 because the equipment is used for the full year. In this exercise, we will calculate the depreciation expense using the activity-based method for 2 years. Movers Corporation acquired a delivery truck on October 1, year 1 for $33,000. The company estimates a residual value of $3,000 and a 6-year service life. It expects to drive the truck for 100,000 miles. In the activity-based method, we allocate an asset's cost based on its use. In this example, the company allocates the truck's cost based on the miles the company expects to drive. We first compute the depreciation rate per mile by dividing the depreciable cost by the number of miles expected to be driven. Depreciable cost is the difference between the $33,000 purchase cost of the truck and the $3,000 residual value. Thus, the depreciation rate is 30 cents per mile. To calculate the depreciation expense for year 1, we multiply the depreciation rate by the actual miles driven for the year. The actual mileage in year 1 is 5,000 miles. For year 1, we multiply the depreciation rate of 30 cents per mile by the 5,000 actual miles to arrive at $1,500 as the depreciation expense. For year 2, the actual mileage is 15,000 miles. We multiply the depreciation rate of 30 cents per mile by the 15,000 actual miles to arrive at $4,500 as the depreciation expense. In this exercise, we will record amortization expense and calculate the balance in the patents count. On January 1, year 1, the company purchased a patent for $300,000. The entry to record the purchase involves a $300,000 debit to patents and a $300,000 credit to cash. At the end of year 1, the company records the amortization expense for the patent. The remaining legal life of the patent is 20 years, but the company estimates the patent will be useful for only 6 more years. This means that the company estimates that the benefits are not expected to continue for the patent's entire legal life. Therefore, the patent will be amortized over a period of 6 years. The amortization expense is calculated as the purchase price of $300,000 divided by the estimated useful life of 6 years. The amortization expense amounts to $50,000 per year. Most companies use straight-line amortization for intangible asset amortization. Patents are an intangible asset that will be amortized. The entry to record the amortization at the end of the year involves a $50,000 debit to amortization expense and a $50,000 credit to patents. Note that we are crediting the amortization to the intangible asset account itself rather than to accumulated amortization. However, using a contra account such as accumulated amortization also is acceptable. At the end of year 2, the company records a similar entry for amortization. In January year 3, the company incurred legal fees of $80,000 for successfully defending the patent infringement suit. Since the legal fees are for successfully defending the patent, the entry to record the legal fees involves an $80,000 debit to patents and an $80,000 credit to cash. At the end of year 3, the company has to record the amortization expense. To record the amortization expense, we need to make two calculations. The first calculation is to arrive at the balance in the patent's account. This gives us the amount to be amortized over the remaining useful life of the patent. Let's look at the patent's T account. In year 1, we debited the account for $300,000. At the end of year 1 and year 2, we credited the patent's account for $50,000 to account for the amortization expense per year. In January year 3, we debited the patent's account for $80,000 for legal fees incurred in successfully defending the patent. The balance is calculated by adding the $300,000 purchase price and the $80,000 legal fees and subtracting the amortization expense of $50,000 for year 1 and $50,000 for year 2. Thus, the balance in the patent's account is $280,000. Now we must look at the patent's account after the legal defense and determine if the amortization for the remaining years will change. The company had originally estimated a useful life of 6 years. Note that successfully defending the patent infringement suit did not change the original estimated life of 6 years. 2 years have now elapsed since the purchase. Therefore, after the legal defense, the remaining useful life is still 4 years. The amortization expense is calculated by dividing the $280,000 balance in the patent's account by 4 years. This is equal to $70,000 per year for each of the remaining 4 years in the patent's useful life. The entry to record the amortization at the end of year 3 would involve a $70,000 debit to amortization expense and a $70,000 credit to patents. The balance in the patent's account, after the purchase, the legal fees, and the amortization for the first 3 years of its life, is now $210,000. In this exercise, we will record the sale of a long-term asset. In the example, the company purchased a tractor at a cost of $33,000. It had an estimated residual value of $3,000 and a 5-year service life. The company recorded depreciation using the straight line method. The company sold the tractor at the end of year 3 for $20,000. The gain or loss on sale is calculated as the difference between the sale amount and the book value on the date of sale. We determine the book value of the tractor on the date of sale as the difference between the original cost and the accumulated depreciation up to the date of sale. Selling a long-term asset can result in either a gain or a loss. We record a gain if we sell the asset for more than its book value. Similarly, we record a loss if we sell the asset for less than its book value. In the first requirement, the sale amount is $20,000. The original cost is $33,000. To calculate the accumulated depreciation, we will first determine the annual depreciation using the straight line method. The annual depreciation is calculated as $6,000, which is the depreciable cost of $30,000 divided by the 5-year service life. The accumulated depreciation at the time of sale is $18,000, calculated as $6,000 depreciation per year multiplied by 3 years. The book value at the end of year 3 is $15,000, which is the difference between the $33,000 original cost and the $18,000 accumulated depreciation for the 3-year period. The gain on sale of the tractor is $5,000, which is the difference between the $20,000 sale amount and the $15,000 book value. The entry to record the sale involves a $20,000 debit to cash for the sale amount, an $18,000 debit to accumulated depreciation for the 3-year period, a $33,000 credit to equipment for the original cost of the tractor, and a $5,000 credit to gain for the gain on sale. Note that this entry accomplishes several things. It updates the balances in the accumulated depreciation and equipment accounts by removing the amounts relating to this asset from the company's books. It records a gain, which is recorded with a credit like other revenue accounts, and records the receipt of cash. Now we will record the sale, assuming instead that the tractor is sold for $12,000. The loss on sale of the tractor is $3,000, which is the difference between the $12,000 sale amount and the $15,000 book value. The entry to record the sale involves a $12,000 debit to cash for the sale amount, an $18,000 debit to accumulated depreciation for the 3-year period, a $3,000 debit to loss for the loss on sale, and a $33,000 credit to equipment for the original cost of the tractor. Note that this entry accomplishes several things. It updates the balances in the accumulated depreciation and equipment accounts by removing the amounts relating to this asset from the company's books. It records a loss, which is recorded with a debit like other expense accounts, and records the receipt of cash. In this exercise, we will calculate the fair value of a new parcel of land. We will also record the exchange of land. The company exchanged the land it had been holding for a more suitable parcel of land. The original cost of the old parcel of land was $80,000, and it is currently worth $150,000. The company also paid $10,000 in cash to complete the transaction. To calculate the fair value of the new land, we need to determine the total value of assets given up by the company in the exchange transaction. The company received the new parcel of land in exchange for the old parcel of land worth $150,000 and $10,000 cash. Thus, the new parcel of land has a total fair value of $160,000. Next, we record the exchange. We debit land, new, for $160,000. This records the new asset at its fair value. To record the fact that the company gave up an old parcel of land, which was carried in its books at $80,000, we credit land, old, for $80,000. Cash is credited for $10,000 because the company paid this amount to complete the transaction. In this case, the $70,000 difference between debits and credits is recorded as a gain. The gain on exchange is treated as revenue. In this exercise, we calculate the return on assets, the profit margin, and the asset turnover ratio. Return on assets indicates the amount of net income generated for each dollar invested in assets. It is calculated as net income divided by average total assets. American Eagle Outfitters, Incorporated, reported a net income of $179. Average total assets is calculated by dividing the sum of the $1,867 beginning total assets and the $1,963 ending total assets by 2. By this calculation, we determine the return on assets to be 9.3%. Return on assets can also be separated to help examine two key business strategies, profit margin and asset turnover. Profit margin is calculated as net income divided by net sales. This ratio indicates the earnings per dollar of sales. The company reported net income of $179 and net sales of $2,988. The profit margin is thus 6%. Asset turnover is calculated as net sales divided by average total assets. This ratio measures the sales per dollar of assets invested. The company reported net sales of $2,988. Average total assets is calculated by dividing the sum of the $1,867 beginning total assets and the $1,963 ending total assets by 2. Thus, the asset turnover is 1.56 times. This means that the company generated $1.56 in sales for every dollar of assets invested. In this exercise, we will check if impairment has occurred and then determine the amount of the impairment loss if required. This exercise can be solved by following a simple guideline. Impairment occurs when the future cash flows generated for a long-term asset fall below its book value. Reporting for impairment losses is a two-step process. The first step is the test of impairment to check if estimated future cash flows from the asset are below the book value. If the answer is yes, then the asset is impaired and we record a loss. If not, then the asset is not impaired and no action is needed. In the first requirement, the operational assets are impaired since the future cash flows of $8 million are less than the book value of $10 million. Once we determine that the asset is impaired, we record the loss. The impairment loss is equal to the difference between the asset's book value and its fair value. The amount of loss is the difference between the book value of $10 million and the fair value of $5.5 million. This is equal to $4.5 million. In the next requirement, we assume that the estimated total future cash flows are $12 million and the fair value is $7 million. The operational assets are not impaired since the future cash flows of $12 million are more than the book value of $10 million. Since the asset does not meet the first test for impairment, no impairment loss is recorded.